Good morning, everyone, and thank you very much for joining me this morning. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is r@fxcm.com, and that's the best way to contact me if you'd like to send me an email. Today is Tuesday, it's the 10th of May, 2022, and I'm just going to bring up our high-risk investment warning. I'm going to keep this on screen for a few moments, and then we'll bring up the commentaries disclaimer. And thank you very much to everyone for joining this morning. Hazelnetta, good morning to you. Thank you so much for joining. Here is our market commentaries disclaimer. I'll keep this on screen for a few moments. All right, and just our references: MarketScope 2.0, CNBC, tradingview.com, and then I just saw an interesting article on a local website, moneyweb.co.za. I'll just give you the sort of basics around that article. It's just interesting. And before we do that, nothing really big on the calendar today, except just note that there are some FOMC members that are speaking this evening. Waller, so Christopher Waller is going to be speaking at the Economic Club of Minnesota. Audience questions expected. And then Mester is going to be speaking as well. Let me just, I beg your pardon. Waller will be speaking 7 p.m. ZA, that's 6 p.m. UK. Mester will be speaking 9 p.m. ZA, 8 p.m. UK. Again, there will be audience questions. Just taking a look here. Mester, due to participate in a panel discussion titled Monetary Policy and Financial Stability Challenges During Balance Sheet Normalization. So you just want to see what comments they make, how they're preparing the market. That's just, I think, something that's worth keeping an eye on. Before we get to the CNBC article, just a headline from the MoneyWeb. The MoneyWeb article, and I thought this was very interesting because we did discuss it at the time when it was current, when it was newsworthy. And the headline reads, "Day Trader Army loses all the money it made in meme stock era." And the reason that I wanted to bring that up is because it's important for us just to keep our heads in trading. As far as I am concerned, we've got a really good webinar going. I suspect that we all treat the markets with a fair amount of seriousness, and we respect the markets. And when you hear these stories and it's the same old story, if it sounds too good to be true, okay, it usually is. This is just vindication. When we heard about Robin Hood, which is I think getting absolutely smashed on the markets at the moment, when we heard about the meme stocks, okay, so they bask in their limelight, but ultimately it always ends the same. Always ends the same. I can't think of a single exception. It may take some time, but it always ends the same. Okay, trading is the hardest money. I beg your pardon. Trading is the hardest easy money, and we all know that. And that's what gives us the edge. That's what gives us the edge, because we recognize it's the hardest easy money. So I just wanted to start off, and I thought that was quite an interesting article. Hey, Katie, good morning to you. Nice to have you on the webinar as always. All right, with that all said and done, I don't want to get more into the MoneyWeb article. If anybody wants it, I'll put it into the chat. But we won't go further into it. Okay, so it's in the chat. If anybody wants to read it, let's go through the morning. The morning article on CNBC. The headline reads, European markets set for negative open amid global sell-off. And European stocks are expected to open lower on Tuesday amid a global market sell-off, prompted mainly by concerns over inflation and rising interest rates and the potential for a global recession. The lower open expected in Europe comes after regional markets fell to 2-month lows on Monday as global investors fled risk assets en masse owing to fears over inflation. The sell-off is not confined to Europe, with US stocks also falling sharply, pushing the S&P 500 to breach the 4,000 level for the first time in more than a year as the market sell-off continued. Monday's move came as Wall Street experienced an erratic last week with eye-popping day-to-day swings as investors weighed the prospects of rising interest rates against the potential of slower economic growth. Overnight, most Asia-Pacific markets fell on Tuesday after the heavy losses overnight on Wall Street, while US stock futures swung between positive and negative territory. The war in Ukraine remains another source of market tension. Russia's President Vladimir Putin attempted to justify his unprecedented invasion of Ukraine on Monday, which was Victory Day in Russia, one of the most important events on the country's national calendar, marking the Soviet defeat of Nazi Germany. The West was preparing for the invasion of our land, including Crimea, Putin said, without providing evidence, according to a Reuters translation. He added that NATO was creating threats at Russia's borders. Earnings Tuesday come from Bayer, Pirelli, a few others coming out. On the data front, Germany's ZEW Institute is set to publish its Economic Sentiment Index for May. All right. Let's take a look at some of the charts. Yesterday we went quite broad. Clearly, just continuing off of the webinar yesterday, the markets aren't at a level that we can call value yet as per the COPOC indicator. It doesn't mean that there isn't it doesn't mean that there's no chance that they will bounce. Of course they may bounce, but COPOC, the COPOC indicator does provide relatively good signals in terms of business cycle bottoms. It's just worth noting that we're not at that value territory yet. We also looked last week at an intermarket relationship between PPI, CPI. We looked at the Fed's funds rate. We looked at GDP growth. Then we added unemployment and the stock market. It also looked ominous. Again, I want to be very clear that we don't want to have a time period bias, which is often what analysts are subject to. Is this happened in 1987? This happened in 2008. So there's a good chance of it happening again. I mean, it might. It really depends on the underlying economic fundamentals. So we just want to not get trapped into it's definitely happening. But if the pattern maintains, then there is a cause for concern. Again, I think we'll tackle that type of analysis again later in the week. But it's worth, I think it's worth just going to a little bit more detail this morning, because we haven't really looked at the charts. So I'm going to spin up. I'm actually going to change the. I'm going to change the layout. I'm just updating a report on Ichimoku, which I need to get finished this week, but I don't want to do the analysis on Ichimoku today. So I'm just going to open my layout. I'm going to go back to the main layout here. All right, and we can. I beg your pardon, I'm just waiting for this to settle. And then we can start, we'll start. Let's start with the DAX and see what the charts are suggesting. Let's go through to our weekly chart. And let's take a look at the stochastic. So this is a stochastic to show you the settings here. So everybody's on the same page. I don't think there's a big difference in terms of the settings. When we started the webinars a few years back, I used a 14.33. One of the attendees suggested a 15.55. I actually think those are really good settings, and there is a lag, but take a look at where we are in terms of the high-low. I'm going to just move this to kind of sort of here, right? So we're kind of moving towards that lower 20. Let's just keep an eye on that. If it hits the lower 20, remember we're on a weekly chart here. If it hits the lower 20 and holds, that's trouble. That's big trouble, because stochastic, in my opinion, is a terrific indicator. It's just so simple, and it captures the essence of momentum. And if we get a stochastic hanging around the 80 area, well, we get a move up. If we get a stochastic hanging around the 20 area, we're going to get a big severe move down. So we just want to keep an eye on this. It has hinged, it's turned over. The angle of the stochastic doesn't look particularly vicious. You know, it's not dropping like a stone, but nevertheless it is negative. Okay, so we just got to keep an eye on that. Now there is, I tell you, something that is sort of nagging at me at the moment is the amount of bearish sentiment is really nagging at me. So what do I mean by that? Well, I'm thinking, if everybody's bearish, you know, well, maybe the appropriate position to take is contrarian. Now, I don't have any positions on at the moment, but the idea is, what happens if this is still a higher trough over here? Which is, now I know that's a change up from what we spoke about in the this morning, that we haven't reached the value stage. We haven't reached the sort of critical mass in terms of what we did last, not critical mass, the critical level that we, in terms of the inflation, GDP growth, unemployment spectrum. But I think there's just a lot of bearishness out there, in that if the whole market's looking to short, they're probably coming in a bit late. In other words, the time to short was with the bear market rally type of thing. Right? So there is, it's seeming to me, maybe the shorting at this stage is fraught with a bit of danger. Whilst I'm of the opinion that we're still potentially soft in the market because interest rates not going away, I'm concerned that we are oversold for the current market. So just bear that in mind. If you take a look at the candlestick, it's looking fairly positive just for this week, and I wonder if we get maybe something like this, and then the next kind of capitulation. In other words, so again, this is supposition. Is the market setting up? Okay, is the market going to suck in the bulls? So in other words, is it setting up for another sucker rally? Okay, so just something, some food for thought. And it's just asking for the RSI, which we certainly can put in. So let's just add that in. Just the settings here, 10, and I don't know, I thought I changed this yesterday. I don't necessarily want to use a weighted, I actually prefer the median. I don't think there's a big difference, but I'm going to just change it to the median. We're not oversold. We are below 50, so we're on the negative side of the 50 level there, Anna, which of course is not an ideal place to be. Certainly, there is room for movement down. I just think that I'd like everyone just to be cautious. With all, I'm looking at the articles this morning. I'm listening to the news. This is just it seems to me there's an excess amount of bearishness. Shorting, of course, might be the appropriate action to take. I just can, if everybody's bearish, it's probably just something you want to be aware of. Let's go down to the daily chart here. All right. Now, the daily chart here, and this is where it's getting really interesting. So we've got the contraction in the Bollinger Bands here. Okay, the contraction in the Bollinger Bands tends to be the signal that there is some sort of expansion. The Bollinger is now starting to expand. We've moved into zone 3, so there certainly is weakness. But take a look what happened with today's candle. Now we're on the daily. Look what happened with today's candle. Okay, we closed here, gap open. See that? There's the close for yesterday's candle. There's the open. So there's a gap open, and then there's just been bullish action. Okay, so perhaps this is where some of the contrarian movement is coming in. We just want to see how powerful this is. It may run out of steam. We are having a stochastic that's rolling over, as the RSI, as Anna's asked us to put in, is showing us we're on the negative side. We do have this 62% retracement. Fundamentally, there is weakness around. It does seem that short is probably the line of least resistance, but I think a lot of the current move, okay, was done earlier. So just shorting at this time, you would need to have your money management. You would need to have your stop losses, and you can see this gap closed very quickly here. Okay, so why would it gap down? There's some sort of excess emotion that gets closed almost immediately. Let's just see if there's any overhead resistance. So what we can do just before we go down to the hourly, just give me a moment. It's now top of the hour. The chart's just hanging because cash markets opened. Give me a moment. Sorry about that. Let's just put in a sort of a resistance area here. Okay, so perhaps there's an opportunity. Again, I just want to suggest, with the market being so bearish, again, we don't want to get trapped in that euphoria. It's not really euphoria. We don't want to get trapped in that fear, right? Yes, it is weak, okay, but just be careful. Whoever sold down into this gap here, somebody took a short position. Yeah, well, they're crying. Okay, let's go through to the hourly. Okay, so this is now, I think, a very important time frame to monitor, because you can see that we've gone positive. Okay, we've got we're moving positive in terms of the EMAs. Okay, moving positive in terms of the EMAs. We're moving positive in terms of the stochastic momentum, positive momentum building up. Okay, positive momentum building up. You don't want to short into that positive momentum. So just what you want to do is not pick the top here, because I don't know where the top is. What happens if it goes all the way to R3? Okay, and we've got a short position on. We want to just make sure we get the triggers. Okay, we must go back bearish on both triggers. And then, even then, the job's not done. The stochastic's going to need to decline. And it just Anna's asking, what's moving the big blue candle this morning? And I am really not quite sure. My feeling is just the excess here. The excess here is the I'm going to say it in the most crude of ways. I think it's the dumb money. I think that the shorting's been done from the up here, you know, all these rallies. So whoever's shorting, yeah, that's kind of the dumb money. And I think what's I beg your pardon for that, but I think the smart money, you know, they were looking, they were questioning, is this the bear market rally? Is this the bear market rally? I would suggest that probably if we do get any rally here, I reckon they'll be looking for a bear market rally. The fundamentals are terribly weak, but the market's never going to move in a straight line. It's always the bear. It's not the bear markets that do the damage. It's the bear market rallies that do the damage. So we want to just be fully aware of that. So what is causing the this sort of gap to close in this movement up here? I think it's just profit taking. Whoever's been selling short now, I think it's under pressure because whoever was selling short here is probably covering their positions. I'm not 100% certain if that's the reason there, Anna, but just sort of that's what comes to mind initially. I'll look around. If there's anything else, I'll write an article about it. But that's what I'm saying is don't get caught. Don't get caught here. What we want to do is we want to see the hourlies roll over. Okay? So we want to see the triggers. Okay, to get the way that we've designed the system is to try and keep us out of trouble, right? So short is probably the line of least resistance. So there's weakness that's clear to see for all of us. The economic environment is stagflationary. We last week we saw that if there is going to be a sell-off, we probably still right at the beginning of it, we probably can take advantage of it. Let's make sure that we don't short into bullish momentum. We don't want to be there, okay? So we don't want to be at the very, we don't have to try to pick the tops. Okay? So it's a fool's errand. We don't want to pick the very bottoms. It's fool's errand. What we want is the meat of the move. Just for example, if you sold short there, you didn't get it, you didn't short at the top. If you covered here, you didn't cover at the bottom, but you got this move here. Well, that's a terrific place to be, right? So again, this swing seems to be done with all the articles and all the negativity in the media. I want us to be cautious, okay? And then when the safety seems to be resuming, that's when we start being suspicious, okay? Because it's a very tricky market to be in at the moment. If we take a look at the US dollar, okay, just on a technical basis, I would still, personally, you know, I think that the dollar still is very much supported, but it is very overbought at the moment, which is part of the reason that I'm worrying. The only game in town at the moment seems to be the dollar. Well, that doesn't feel very comfortable to me. You know, we were talking buying dollar months ago. Now everyone's talking about buying dollar. I think that a lot of the dollar bulls are going to be looking to start banking. I think they're going to start looking to banking. So just again, be cautious. Yes, the momentum's there. Okay, and take a look at the RSI. This is a problematic chart right here, because overbought on the weekly chart is almost puts us like deer in headlights, because yes, we recognize that the market risk is skewed. It's skewed against the longs. The problem is how long the weekly chart is lousy for timing. Timing is you know, some people just say it's impossible to time the market. We try on a lower time frame. Trying to time it on a weekly, I don't think is really appropriate time frame. So yeah, we overbought. Okay, we overbought. When is this going to correct? And Anna actually wrote something interesting here. She says, look at the ranges. So we've got the ranges building up, and now they're starting to narrow. So it's losing a bit of emotional momentum, isn't it? The dollar isn't quite as good as it was a few weeks back. Let's go through to the daily chart here, and you can see that there is an overbought condition here as well. Now, I'm not big on divergences. I'm really not. Okay, but there's a divergence here. What we can perhaps do is add a stochastic here. The stochastic divergences are more accurate in mind. Let's see if we have some sort of divergence there. I'm really not a technical analyst that enjoys using divergences. I think they work just enough times to keep people interested. But let's just take a look and see what it says. Okay, so we will use the SSD here. And the divergence here is apparent as well. Why I think the divergence works better on the RSI is telling us we're overbought. RSI is telling us overbought. Why I think the divergence works better in the stochastic is because, in my view, subject to correction, is a much more accurate representation of momentum than RSI. RSI is a much more accurate representation of excess. And what we should do here is add a %D just to see if it's crossed over. And it had crossed over slightly. So if it crosses down, back down below 80, and get some of the RSI, some of that froth out of it, I think that would be a much more comfortable position. But we still got this weekly overbought condition to deal with. So again, I saw an article yesterday saying everybody's buying dollar, everybody's buying dollar. If everybody is buying dollar, that's a huge warning sign. Okay, not because the dollar is doesn't deserve to be supported, but it's probably a time when the big players are starting to profit take. Okay, be aware of that. If the dollar is starting to look overbought, you can go through to Bitcoin. Okay. It's let's go to the daily. It's oversold. Okay, it's oversold. All right. So whoever's looking to short Bitcoin, well, you're probably going to get some Bitcoin shorts starting to cover their positions. And the way that the market tends to work is short, okay, kind of a long, short. I still think the fundamentals are dollar positive. So then we kind of get some sort of sucker rally, and then we want to treat that sucker rally with the suspicion it deserves. Oh, I deleted the wrong thing there. Let me just add that. Just going to add that Bollinger back. I wanted to show you guys something here as well. Sorry, one more thing. Okay, you've got a squeeze here. Okay, the squeeze here. Okay, so definitely we saw that volatility coming, and I think we've spoken, I beg your pardon, about the squeezes that are starting to manifest. I think last week we even looked at the Bollinger Band width indicator. We saw that Bitcoin was really getting to that level where there was that squeeze. So again, whilst I don't think Bitcoin ultimately is at a low, I think it might be at a short-term or a near-term low, just as the dollar, in my opinion, may be at a near-term high, because it just seems overdone, overcooked. It's the dips in the uptrend, the rallies in the downtrend that we really focus on. Just something that I did write an article about here on, just want to take this out. This is the Bitcoin Weekly. I'm not fond of writing articles which put targets in because it's forecasting. forecasting cannot, I'm convinced it cannot be done, but they get the best hits in terms of your SEO, right? So I thought, well, what is the technical target here? And there is an actual technical target of about $25,000, a breakout out of this rising wedge pattern. In fact, when I looked at my notes, I haven't even put this targeting correctly. The notes actually extend the target down to there. And if that's where the target is really meant to be, okay, then we're looking at we're looking under 20,000 in terms of this, in terms of the breakout from the rising wedge. So the technical target here, which again I want to emphasize, means absolutely nothing. Sometimes they are hit, sometimes they're not hit. There's problems with targets themselves. Are you doing a target on an arithmetic scale, or are you doing it on a logarithmic scale? But the point is that the rising wedge is a bearish continuation pattern. We have broken out of it. Prices don't move in a straight line. We may see some sort of bounce, and we may see the next leg down. It doesn't move in a straight line. There is just an awful lot of bearishness out there, and I think that whilst in the medium to long term probably justified, the near term makes me feel very uncomfortable. We are hinging here, and we are moving down towards the 20 level. Yeah, target round about the 8,800. It gets worse than that, by the way, Anna. It gets much worse than that. If you want to look at technical targets, the real scary one is this one. The real scary one for Bitcoin is this one. Again, I want to emphasize the technical target is really sort of a cool thing to chat about, to talk about. It's not a good thing to trade on, okay? But if you kind of look at this neckline here, okay, if you look at this neckline here, well, here you've got a double top, 1, 2, and let's put target here. There's a technical target here. Looking at under 15,000, looking at 13,000 there. So it may, it may be hit, and then I could be cheeky and say, "See, I told you so." But the truth of the matter is, I have absolutely no idea if 13,000 is going to get hit or not. We may get some sort of bullishness and bounce from here. So the point is, don't get locked into the target. That's not the way to approach the markets. We want to approach it trying to match up the fundamentals with the technicals. Yes, it does look like rates are moving higher. Yes, it does look like dollar is supported. Medium to long term, my view is very much that. Near term, I think we've got to be very careful. And you can see that the let's go through. You can see there's some sort of blue that's coming through on Bitcoin here. When we looked at the DAX, there was certainly some strength coming in here. I wouldn't be surprised to see a short-term bounce. When that happens, we're going to start looking at the resistance areas. We're going to start looking at the key reaction levels. We're going to see if those are respected, because those are the levels that the shorts are probably targeting, and we want to target those as well. All right. Any questions? Any other questions? Please go ahead and it's saying could, not must, to keep us careful. Yeah, I'm just saying be very, very careful out there. If you're going to trade, look, I don't know, the market might sell off. There is a fair amount of bearishness out there. But the idea is, if you're looking to make that trade, stop loss, and money management, very important. All right. What we'll do is we'll wrap up here. I'll put this onto Telegram. We'll do it all again tomorrow morning. Thanks very much, guys.